Well, I have some market news for today. Earnings season getting started. Friday, always we get the banks, so that marks the start of the earnings season. With JP Morgan, Wells Fargo City. Won't be trading any of those, but next week we got Netflix, we got Tesla. I really like to watch economic reports, especially reports that have an impact on the market, like the non-farm payroll does. On Friday, we got the last non-farm payroll. But what the hell is happening to reports? When even reports are badly reported, what do you look at? Job reports, non-farm payrolls, have been revised down 4 out of 5 times this year alone, with the biggest downward revision was in January from 353,000 jobs reported, revised down to 256,000. February, they revised down job report 39,000 jobs. April, 67,000. May, 54,000. That's a total of 240,000 jobs mistakenly reported. So I'm a little bit disappointed with this, Julia.
Actually, they raised the age of retirement to 10 years after you die. So I think that might be where this error in accounting is coming from. This is a little concerning. I think, like, from a perspective, like, because I work a lot with data, so I appreciate that they're going back to revise these reports and sort of like accounting for those estimates. I did not know how much of an estimate these really were, but now looking at the numbers, that makes a lot more sense. Think that, like, if this is a little bit more consistent with, I think, the anecdotal experience that a lot of people have been feeling as it pertains to the job market and how accessible certain jobs are. So, like, okay, now the data's lining up a little bit more with what everybody's been feeling and talking about. Tracks. But this is a little bit concerning because of how much relevance this has to the economic decisions at the federal level, specifically when it comes to, like, interest rates, when it comes to our handle on inflation, when it comes to concerns over, like, the longevity of the dollar and all of that. So that's, like, good to know, actually, because I did not know how much of an estimate these reports actually were.
Going next to the market breadth, Julia, I saw this from the Compound, this report that only 17% of members have actually outperformed the S&P 500 over the past month. This is the lowest outperformance in a decade. I put on purpose the yellow S&P 5, but we all know that it's the S&P 500, and that have had a high return than the index itself over the last month. While the long-term average, here you see the red dotted line in the middle, it's actually a 49% that the companies outperform the index itself. So only 70% of the companies are outperforming it. We all know which those 5 names are.
Yeah, I'm not surprised about this. I can actually calculate it. I don't know if I can calculate it on the spot right now, but, like, which components are outperforming versus underperforming the S&P. 17%, I'm not surprised, because when I did this study 6 to 8 months ago, it was like 25% were outperforming the S&P, and now it looks like it's even fewer than that. But 17% just sounds right about right, which is a little bit concerning.
And then Powell in Congress, what he said, it is not likely that the next policy move will be a rate hike. When he said that, the market jumped a little bit. I think that's the only thing new he said, besides all the stuff he's always said before. So there will be no rate hike for the next one. The first quarter data for this year did not support enough confidence in inflation and path to rate cuts. So that's good news for the banks. Higher rates, interest rates. The U.S. economy is expanding at a solid pace. He said that. And also labor market conditions have cooled but remain strong. Definitely watching the revised downward non-farm payrolls and unemployment going from 3.9% 2 months ago to 4.1%. That's what you want to see. There was a lot of questions being asked, I think, from the Congress lately, especially over housing. And I found this one. I couldn't find like a newer one for the Housing Affordability Index. This is from Goldman Sachs. The base level is 100, so above 100, housing more affordable. Below 100, less affordable. So as of the end of last year, and I'm sure as 2 weeks ago, the median house prices actually reached its highest price ever. Right now, home prices are the least affordable since 1997. I think that's definitely something to take into account. And the low weeks as of this time of the year compared to all the years since 1990, to a bespoke report, it's below its average. The median at this current time is actually at 15.95. The VIX, but it's trading at $12.4. The VIX. What are your thoughts on the VIX?
The VIX is starting to rise right now, but probably short-lived. Yeah, I think it's just because of the gains that we're getting back, I suppose. When we hit all-time highs overnight, now we're starting to give some of that back. The Qs are actually red last we checked in on it. What do I feel about the VIX? So the VIX is currently at 1243. The lowest value of the VIX, I'm trying to remember, I've looked at this data set so many times, but I believe it's around like 7. But a really good chunk of the VIX is like between 10 and 15. I think like maybe you and I are not as used to it because like I at least started trading during 2020. So like having the VIX around like 12 around that to me is a little bit unusual.
Yeah.
But I mean, there are still like high pop strategies you can employ during that time. It's just a matter of like being very diligent about controlling sizing because the problem is VIX is around 12. There's probably not a lot of room for a contraction. So you can still have like short premium SPY positions on, for example, but a lot of that profit is probably more going to come from theta decay rather than a VIX contraction, right?
Yes.
So what that means is that sometimes you have to have the position on longer, like closer to 21 days, maybe even a little bit sooner than that for that theta decay to kind of like catch up to your profit targets. But what that means is like a lot of the time the investor psychology can start to work against you. You can get impatient, you can start to overload positions. And then if there is one of those super rare vol pops, a bunch of positions are exposed to that. So the VIX being low is like annoying. It's kind of like disincentivizing, but you can still trade profitably during that time, at least according to like some of our studies, right? At least on the, tasty trade research side. This is not unusual though. It feels like a little weird given, the couple of years we're coming out of, but it's just statistically not very uncommon, I guess, to be where we're at right now. It's a little weird, but this is business per usual.
And another news that I think it's to worry about is that bankruptcies are on the rise on the US. I haven't really heard, I don't know if you or hear people watching about more bankruptcies on the rise. Maybe they are not as well-known companies or very much covered. Bankruptcies hit their highest level in more than 14 years. June of this year, we saw the last time we saw so many bankruptcies for a single month. So June was on June of 2020, when there were 74 companies went on bankruptcy. But when you compare unemployment rate with June of 2020 versus now, it was at 11.1% versus a 4.1% we saw on last Friday. So as we see right now, the year to date, 346 companies are actually bankrupt so far now. We'd like to see which companies are there and if they're also publicly traded companies.
So with bankruptcies on the rise, dude, I've been watching bankruptcies a long time, like especially when it comes to like bank collapses and the potential of contagion. We've talked about that many times on the show about like why we're watching that, why it's going to be important. In terms of like actual bankruptcies, I don't know. I know a lot of people are concerned with just like the level of consumer debt in the United States right now. I think this is kind of, I don't know if this is like a tipping point necessarily, but I know that it certainly feels like a bubble that's going to pop at some point.